It begins quietly, almost imperceptibly. Farmers in the Midwest notice smaller orders, logistics companies sense reduced shipments, and commodity traders report unusual declines in futures prices. Then the announcement comes. China, citing policy shifts, geopolitical strategy, or alternative sourcing, has stopped purchasing U.S. soybeans entirely. Overnight, the largest export market for one of America's most important agricultural commodities disappears. The first impact is financial. Soybean prices, previously buoyed by robust demand, collapse rapidly. Futures contracts drop sharply, triggering margin calls for traders, hedge funds, and investment firms with exposure to agricultural commodities. Farmers, many of whom operate on thin profit margins and rely on predictable exports, face catastrophic losses. Debt-laden operations struggle to meet loan obligations, equipment leases, and payroll requirements. Rural banks, heavily tied to agriculture, encounter liquidity stress. The U.S. agriculture sector is thrown into chaos. Soybeans are a cornerstone of crop rotation, livestock feed, and biofuel production. Farmers unable to sell to their largest buyer scramble to find alternative markets, often at significantly lower prices. Domestic buyers cannot absorb the sudden surplus, leaving storage facilities overflowing. Unharvested crops rot in fields as logistics networks are overwhelmed, compounding economic losses and environmental waste. The ripple reaches Wall Street quickly. Publicly traded agricultural companies, equipment manufacturers, fertilizer producers, and food processing corporations experience stock declines as investors reassess risk exposure. ETFs and mutual funds with significant agricultural holdings lose value, affecting retirement accounts, institutional investments, and individual portfolios. The perception of systemic vulnerability in U.S. agriculture triggers broader market anxiety. Rural economies are devastated. Communities reliant on soybean production, including towns, transportation networks, and local service industries, experience immediate economic contraction. Schools face budget cuts as property tax revenues decline. Local retailers, contractors, and service providers see reduced spending. Rural unemployment rises sharply, increasing reliance on federal assistance programs. Social consequences, including mental health challenges, family stress, and community instability, intensify. Commodity markets react globally. Countries that import soybeans, including European and Asian nations, scramble to adjust supply chains. Alternative exporters, such as Brazil and Argentina, capitalize on the U.S. market void. Prices fluctuate internationally, creating volatility in global food markets. Investors diversify holdings, reallocating capital from U.S. agricultural commodities to other assets. Market perception of American agricultural stability is severely undermined. Supply chains for livestock, poultry, and dairy are affected immediately. Soybeans are a critical component of animal feed. Shortages and price spikes in feed increase production costs for farmers and food manufacturers. Meat, dairy, and egg prices rise domestically, fueling inflationary pressures. Food manufacturers adjust contracts, reduce production, or pass costs to consumers. Retail grocery markets experience uneven availability and price volatility. Government intervention becomes urgent. USDA programs, subsidies, and emergency relief measures are mobilized to support farmers and stabilize the market. Tariffs, export promotion programs, and domestic consumption incentives are considered to mitigate losses. Yet even aggressive intervention cannot fully offset the shock of losing a market as significant as China. Fiscal pressure increases, further stressing federal budgets and long-term economic planning. Banking and credit markets feel the strain. Agricultural loans, lines of credit, and mortgage obligations face higher default risk. Rural banks, heavily exposed to agricultural clients, experience liquidity challenges. Credit availability tightens and borrowing costs rise. Lenders reevaluate risk portfolios, shifting investment away from agriculture and related industries. Financial contagion spreads to regional economies and credit markets. Stock markets respond with volatility. Publicly traded agribusinesses, food processing companies, and equipment manufacturers decline sharply. Broader indices react as investor confidence in U.S. economic resilience is shaken. Volatility indexes spike, reflecting heightened systemic risk. Hedge funds and institutional investors adjust positions, often selling U.S.-exposed assets in favor of global diversification. Corporate supply chains are disrupted. Companies reliant on soy-based products for manufacturing, livestock feed, or processed foods face higher input costs and uncertainty. Production timelines are delayed, contracts renegotiated, and long-term sourcing strategies reconsidered. Retailers face price increases and potential shortages in processed foods and meat products. International customers who relied on U.S. soy exports explore alternative suppliers, accelerating a permanent shift in trade dynamics. Agricultural innovation is affected. Research and development in crop science, seed technology, and sustainable farming practices face reduced funding as revenues decline. Universities, research institutes, and private agricultural companies experience delays in projects and innovation pipelines. The U.S.'s global leadership in agricultural technology is challenged as competitors capitalize on the disruption to increase market share. Energy and biofuel sectors face secondary impacts. Soybeans are a critical feedstock for biodiesel production. Reduced soybean demand lowers feedstock availability and disrupts biofuel supply chains. Production costs increase, alternative inputs are sought, and energy companies adjust strategies. Federal renewable energy mandates may require adjustments, creating regulatory and logistical challenges. Consumer behavior is influenced. Rising food prices, particularly in meat, dairy, and processed foods, reduce discretionary spending. Households adjust budgets, delaying non-essential purchases. Inflationary pressures interact with reduced disposable income, slowing economic growth. Public perception of food security and economic vulnerability creates societal stress, influencing consumer confidence indices. International diplomacy experiences tension. The U.S.-China relationship, already fraught with trade disputes and geopolitical rivalry, deteriorates further. Other countries monitor the disruption, evaluating alliances, sourcing strategies, and investment opportunities. The loss of a key export market reduces U.S. leverage in trade negotiations and diplomatic engagements. China's agricultural influence expands globally as it directs its sourcing strategy toward Brazil, Argentina, and other partners. Employment across sectors is affected. Farm labor, transportation, processing plants, and rural service industries face layoffs and reduced hours. The ripple extends to equipment manufacturers, fertilizer producers, and logistics companies. National unemployment figures rise, creating pressure on social welfare programs and increasing federal budgetary requirements. Workforce retraining and support programs are mobilized but cannot fully offset widespread job losses. Credit markets adjust risk expectations. Agricultural risk premiums rise as lenders anticipate defaults and reduced profitability. Interest rates for farm loans increase, creating a feedback loop of financial pressure on already distressed operations. Institutional investors recalibrate portfolios to hedge exposure to commodity shocks and agricultural instability. Global investors monitor U.S. agricultural risks, influencing currency and bond markets. International markets reflect volatility. Countries dependent on U.S. soy exports, including Japan, South Korea, and parts of Europe, face supply disruptions and price fluctuations. Alternative exporters capture market share, accelerating structural shifts in global agricultural trade. Commodity exchanges reflect uncertainty, with price swings and futures volatility increasing. Food security concerns are elevated in regions dependent on stable U.S. supply. Corporate risk management strategies shift. Firms dependent on soybean inputs diversify sourcing to include Brazil, Argentina, and other South American producers. Vertical integration becomes more appealing to stabilize supply. Inventory management, logistics planning, and contractual hedging are reevaluated to mitigate future trade shocks. The American agricultural export model experiences structural reconfiguration. Environmental consequences emerge. Oversupply of soybeans in the U.S. leads to unharvested crops, waste, and potential soil degradation. Farms overextend land use to compensate for reduced prices, causing stress on local ecosystems. Crop rotations, pest management, and soil fertility are disrupted, creating longer-term agricultural productivity challenges. Political consequences intensify. Domestic debates on trade policy, tariffs, subsidies, and agricultural strategy dominate media coverage and legislative sessions. Populism, protectionism, and rural advocacy gain momentum as citizens respond to economic distress. Policymakers are pressured to enact emergency relief, negotiate trade solutions, and maintain national food security. The food processing industry experiences cascading effects. Soy-based products, tofu, soybean oil, and processed foods see input cost volatility. Manufacturers adjust recipes, sourcing, and pricing strategies. Export-dependent companies face contractual renegotiations and penalties. Retail and wholesale markets feel the downstream effects, creating price fluctuations for consumers. Global trade dynamics shift permanently. U.S. soy exports lose market share to Brazil and Argentina, creating long-term trade realignments. Global commodity flows are altered, influencing international logistics, port operations, and trade finance. U.S. influence in agricultural markets diminishes, reducing bargaining power and global economic leverage. Insurance and risk management sectors are stressed. Crop insurance payouts increase dramatically, creating fiscal pressure for both private insurers and government-backed programs. Farmers unable to recover lost revenue experience financial insolvency despite insurance. Risk assessment models are revised and premiums increase, creating long-term structural financial implications for agricultural producers. Stock markets continue to reflect systemic uncertainty. Agribusiness ETFs, food processing companies, equipment manufacturers, and regional banks tied to agriculture experience volatility. Institutional and retail investors reassess exposure, leading to further sell-offs. Broader equity markets react as confidence in U.S. economic resilience is challenged. Rural communities confront long-term socioeconomic change. Population decline accelerates as younger generations migrate toward urban centers for employment. Local infrastructure, schools, and services are stressed. Cultural and social networks face disruption. Economic recovery requires targeted policy intervention, investment, and structural adaptation. Over decades, the U.S. agricultural sector rebuilds. Farmers diversify crops, expand international markets, and adopt innovative technologies to mitigate future trade shocks. Policy reforms, trade agreements, and infrastructure investment support long-term stabilization. Yet China's permanent exit from the U.S. soybean market leaves lasting structural consequences for pricing, competitiveness, and export strategy. Ultimately, China's decision to stop buying U.S. soybeans demonstrates the fragility of economic dependence on a single export market. Stock markets, rural economies, corporate supply chains, and international trade are profoundly affected. Recovery requires innovation, diversification, government intervention, and global market adaptation. The scenario serves as a stark reminder of geopolitical influence on domestic economic stability and the interconnectedness of global trade. The story of a sudden loss of China as a soybean buyer is more than an agricultural crisis. It is a lesson in systemic risk, market dependence, and the need for strategic foresight. The consequences ripple across the economy, society, and global markets, illustrating how a single trade disruption can reshape financial, industrial, and political landscapes for decades.